Hello and welcome back, everyone. And I wanted to share this with the group because it was a good question that I received from one of the coaching calls. And the client was asking, should you consider deltas for covered calls, for the strategy of the covered call? And it's a really good question because in a lot of cases, we do consider the deltas. But that's usually when you're after gains. To capture the gains with a covered call, you are selling off gains. So as we're going to find out in this video, the deltas really aren't of concern. It's more about how much money you're receiving, how much of a downside hedge you're receiving, and it really has very little to do with the deltas. So let's take a closer look at the things you should consider for the covered calls. So if you're not too familiar with the strategy, the covered call is one where you're going to buy, let's say, 100 shares, or maybe you already have it in your account. And then you're going to sell a call against those shares. So maybe you sell the $50 call. And by selling that call, you now have the potential obligation to sell your shares for the strike price, or in this example, 50 bucks. So again, the question is, should you consider the deltas for the calls you're selling? Should I look at my broker's platform and say, well, this one's a 50 delta, or this one's a 70 delta, and this is the one that I want to sell just because of the deltas? So let's start by considering an example where you buy 100 shares of stock and you sell the $50 call for 5. If you do that, your profit and loss diagram looks like this. However, if we overlay it with just the long shares of stock, this is what the long shares look like. So here's the long shares of stock purchased for 50, just this straight red line. And again, the covered call here in blue. So remember that you always get a bend at the strike. So that's our 50 strike. So at any stock price above 50 at expiration, we don't participate in the gains. And that's why this blue line flattens out. Well, that's not a benefit. You know, look at the stock up here. It continues higher and higher if we had just held the stock. So no, there's not really a reason to say I want to focus on when I'm going to start flattening out my gains. The big benefit from this is not that we've limited the upside, but is the fact that we've reduced the downside hedge. We break even at 45 now instead of at 50. So this is what we look like at expiration. But today we're going to look something like this. But again, notice that as the stock price rises, we start to reduce the rate at which we earn money. So that's not really a benefit. And that's the only thing you would gain by focusing on the deltas. At what point do we want to start limiting our gains? Well, what's that really going to do for you? The thing that you have to understand is that for the covered call, the main reason for selling the calls is the downside hedge. It is not income generation that a lot of people advertise it to be. In a way, you can think of it as income generation, but what you're really doing is that you're selling off potential future gains. And that's very different from buying an asset to, let's say, rent out to another, which is usually an analogy that's made with a covered call. But the main reason for this call is that you're receiving cash up front today. It's the bird in the hand in exchange for limiting the upside gains. So again, delta only shows how quickly you're going to slow down the returns. That shouldn't be your focus. What should it be on? We want to focus on the returns. How much money am I making? Is it going to fit my goals and my needs? How many dollars are we making, not how many deltas did we sell? And the second thing is we need to focus on the downside hedge. So to do that, there are really three main returns that you should watch for a covered call. There's what's called a static return, and this is your ROI, or your return on investment, assuming the stock price is the same, or what we call static at expiration. There's a second one called the return if exercised, and that's the ROI assuming the stock has been called away, that the person who bought this call actually exercises it. And then the third one is the break-even percent. This calculates how far the stock price can fall for you to break even. So for instance, the static return, let's say that we buy shares at 50 and we sell the $55 call for 2. Well, my cost basis is 48, right? Because I spent 50 and I collected 2 when I sold this call. So if the stock is 50 at expiration, in other words, it's static, then the ROI is the $2 that we received divided by the $48 effective cost basis, or about 4.2%. So if this is a 1-month option, to annualize that, we would just take 4.2 times 12, which is 50.4% annualized. But if we just held the shares, we made zero. And that's because we bought the shares at 50 and they ended up at 50 at expiration. So this is one thing I'd like to know. If the stock price goes nowhere, is this return going to be sufficient for my goals? Now, if this return is higher than what I need, then I should probably write it more in the money to create a bigger downside hedge and a smaller return. But this is one of the things that you should consider. Next thing is the return if exercised. So same example, we've got 48 bucks into it. But what we're assuming now is that the stock is at 55 or above at expiration and we lose our shares. Now, as a side note, just because you might be getting into this range doesn't mean you have to lose your shares. We could roll out the option, but it's just a way of saying, if this happens, what's my return? So in this case, if the price is above 55, your return is now $7. Why? You've got a cost basis of 48 and you end up selling for 55. So that's 7. We could also say that the stock appreciated from 50 to 55, that's $5 plus the $2 you receive from the call. A couple of ways of coming out with the same answer. So that's $7 out of a $48 cost basis. That's 14.5%. Again, if this is a 30-day option, that's 174% annualized. But for the stock trader, that's only a 10% increase or 120% annualized. So those are very different returns. Now that might not seem like a whole lot, 14.5 versus 10%, but you have to realize that with the compounding, that is enormous. It's a very, very large difference. So that can be a very big benefit of using a covered call. And then finally, the break-even percent. This is going to check how much of a downside hedge we have. So again, we've got the same example, $48 cost basis. So that means if the stock price is 48, at exactly 48 at expiration, then we just broke even. The return is 0. And therefore, your break-even percent is 4%. So that's just saying that the stock can fall from 50 down to 48 or 4%, and we really didn't lose any money. But if we just held the shares of stock, we'd actually be down 4%. So these are the things that you want to focus on as a covered call writer. It's more about the money, the financial gain, and the safety net, the downside hedge, but it's not about the deltas that you're selling. And part of the reason is that depending on the volatility, price of the stock, time to expiration, if you focus on deltas, all of these answers are going to change. So instead, you always need to focus on what are your goals, how much of a downside hedge do you need, and then let the numbers play out. But you're never going to find that answer by just looking at your deltas. So for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.